All right, let's dive into one of the most unique corners of the new Income Tax Act, 2025. We're talking about how to tax insurance businesses. It's a special kind of challenge, and the new law gives us a special tool to handle it, Section 55. We're going to unpack exactly how it works in this explainer. So here's the core problem, right? Think about it. Most businesses make a sale and they calculate their profit. It's all based on things that have already happened. But an insurance company, their entire business model is based on predicting the future. What are the chances of a claim? What might future losses look like? This fundamental uncertainty means your standard tax rules just don't fit. And that's because there's this huge mismatch. An insurance company collects premiums from you today, but the claims they have to pay out on that policy might not happen for months or even years down the line. Because of this time lag, you need a completely specialized framework to figure out what their true taxable profit actually is. I love this analogy because it just captures the problem perfectly. Standard tax rules are like a ruler. They're rigid, they're meant for concrete, solid figures. But insurance profits? They're more like a liquid. You need a specialized measuring cup, not a ruler. And under this new act, that specialized tool, well, that's Section 55. So what the Income Tax Act 2025 does is it creates this gateway, Section 55. You can think of it as the single point of entry for calculating the taxable income of any insurance business. It tells you to set aside all the usual methods and instead follow one clear, tailored path. The section literally starts with the words, irrespective of anything to the contrary contained in the provisions of this act. Now, in legal terms, that's called a non-obstante clause. But what does that really mean? It's a trump card. It says, hey, forget about the other computation sections for things like capital gains or other income sources. When it comes to insurance, you follow only this specific roadmap, and that roadmap is laid out in Schedule 14. And just for a little context, especially for those of us familiar with the old 1961 Act, here's how it maps out. What used to be Section 44 is now Section 55, and the detailed rules that were in the first schedule have now moved to Schedule 14. So it's a pretty direct and clean transition, which definitely helps. Now, Schedule 14 itself is split into two parts. Let's start with Part A, because it deals exclusively with life insurance. And let me tell you, the method here is completely different from pretty much any other business you'll encounter. So, the most important principle for life insurance is that you don't start with a traditional profit and loss account. Nope. Instead, the company has to do a really detailed actuarial valuation to figure out its surplus. It's the annual average of this surplus that actually becomes the basis for taxation. Even the credit for TDS is averaged out over that period. It's a totally unique system. Okay, so that was life insurance. Now, let's switch gears and look at Part B of Schedule 14. This part covers everything else. We're talking general insurance, fire, marine, you name it. And the way we calculate profits here is a whole different ballgame. It's a very structured, adjustment-based approach. For these non-life insurers, it's a pretty clear four-step process. Step 1, you start with the profit before tax right from the P&L account, which, by the way, has to be prepared as per IRDA regulations. Step 2, you add back any expenses that the Tax Act doesn't allow. You know, things like provisions for tax or certain reserves. Step 3, and this is the crucial one, you make very specific adjustments, especially for the reserve for unexpired risks. And finally, Step 4, you arrive at your final taxable profit. So that brings us to the single most important adjustment, this reserve for unexpired risks. What on earth is it? Well, at the end of the year, an insurer has a bunch of policies that are still active, right? This reserve is basically a provision they set aside from the premium income to cover any potential claims that might pop up on those active policies in the future. And the best part? It's an allowable deduction. But you can't just reserve any amount you feel like. The law is very specific. The Income Tax Rules 2026, specifically Rule 3360, set clear limits. For marine insurance, which is super high risk, you can reserve up to 100% of the net premium income. For all other types of general insurance, the limit is capped at 50% of the net premium income. Let's put some numbers to this to see how it works. Okay, imagine a general insurance company. Their profit as per the P&L account is 50 lakh rupees. They also made a provision for income tax of 15 lakhs. Their net premium income for the year was 80 lakhs. So first, we take the 50 lakh profit and we add back that 15 lakh tax provision because it's not allowed. Now we calculate the reserve for unexpired risks. It's general insurance, so it's 50% of the 80 lakh net premium, which is 40 lakhs. We subtract that, and there you have it. The final taxable profit is 25 lakh rupees. Simple as that. So we've got the theory down, but what does this all mean in practice? Let's talk about the key compliance points and some of the real-world issues that professionals really need to be aware of. First things first, if a company handles multiple types of insurance, say life and general, the law says you must maintain completely separate and distinct accounts for each. No mixing. Your P&L has to strictly follow IRDA norms. That's your starting point. And of course, getting the net premium income calculation right is absolutely vital for your reserve claim. And as always in tax, documentation for everything is non-negotiable. There are a few common traps that people fall into. A big one is applying that 50% or 100% reserve limit to the gross premium instead of the net premium. That's a classic mistake. Another one is just forgetting to add back all the inadmissible provisions from the P&L. Honestly, to avoid any headaches during a scrutiny, just remember, meticulous classification and rock-solid documentation are your best friends. Whew, we've covered a lot of ground on Section 55, so let's just take a moment and boil it all down to the key takeaways, the things you absolutely have to remember. Here are the 5 things to lock in. 1. Section 55 is a complete, self-contained code. 2. The rulebook for computation is Schedule 14 and only Schedule 14. 3. There are 2 very different paths. For life insurance, it's all about the actuarial surplus. 4. For other insurance, the P&L account is just the beginning of the journey. And 5, that reserve for unexpired risks is the single most significant adjustment you're going to make for general insurers. And that kind of leaves us with a final thought to chew on. The big goal of the new act was simplification. But for the insurance sector, did it really achieve that? Or have we just taken all the complexity from the main sections of the act and packed it into a highly detailed and still pretty complex schedule? It's definitely a question worth pondering as we all get used to this new law. And that's a wrap on our deep dive into Section 55. We really hope this breakdown was clear and helpful for you. If you found it valuable, you know the drill. Please give it a like, subscribe for more, and share it with your colleagues and network. And just a quick reminder, this presentation is purely for educational purposes, and it is not professional advice. Tax laws are always subject to change, so please always consult with your professional advisor before making any decisions.